We got check marks. People are here. I'm here this week with Dustin Williamson. He is the managing director of the Houston office of VCFO. And today we're going to be talking about regrets in deal making. And we'll be right back. I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium-sized businesses while controlling risk. So if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you a small business owner that's thinking about exiting your business now or in the next few years? My team and I are here to help with our unique zero commission program that we've been using since 2016. We can show you what your business is worth, prepare the package you'll need before you meet your first buyer, even run a confidential online advertising program for you just like business brokers do. And we'll coach you through the whole process, or you can hire us to manage it all for you, including coordinating your whole sell-side deal team. Head over to howtosellmyownbusiness.com to learn about how my team and I can help you get ready by watching a series of videos we prepared that explain each step in detail. And if you're ready or just curious to learn more, reach out to us and we'll get you started or schedule a call to answer your questions. I look forward to meeting you and learning more about your business. Well, I don't know, that the intro reel was kind of stuttering on my end. Was it on your end too?
No, it was great, and I really
Okay, all
appreciate
right.
you having me, David. And this is a great experience.
Well, thanks for coming over. Dustin, I want to give you a chance to introduce yourself. I said you were in Houston. You want to give us a little bit about your background in the world of finance and deal making? I'd like to know about, the kinds of businesses that you've worked with and sort of the size of those businesses and the kinds of deals that you've helped advise people on before.
Yeah, I'll jump right into what we do, and then I'll go from there into my background. But number one, thanks for having me. Number
No problem.
two, VCFO is a fractional services firm. We deal with CFOs, high-end controllers, all the way down, all the way through the stack of lower level controllers and more administrative bookkeeping type people, but just one level above that. And so we also do HR, and it's all on a fractional or interim basis. The crux of where we focus our time and attention is between 10 and 150 million in revenue. And that's usually coincides with about 10 to 150 employees. Sometimes we go above, and sometimes we'll go below. But when we go below, that's typically in the realm of funded VC private equity deals that people are willing to invest in their business. And so we're industry agnostic. There's not really any industries that we won't touch, and we're system agnostic, and there's not many systems we haven't seen. And so we have 4 different markets, Houston being one of them, but the largest and oldest is Austin, where we started the business 28 years ago and pioneered the fractional CFO services division within finance. And we're also in Denver, Dallas, obviously Austin, and obviously Houston. So we cover a big area. It's not like we're focused on those geographic areas as our only markets. We can cover everything we have clients that are international. We have clients in other states all the way up to Hawaii to Costa Rica. There's a lot we can do remotely, but if we're in person, it's usually going to be in one of those 4 markets.
And just for people who may not be aware, what is a fractional CFO?
Yeah, and there's a big difference between fractional and interim. Fractional is when we're focused on your next 3 to 5 years, we're focused on your growth up and to the right, and we're really acting as if we are your CFO or controller or high-end HR person. And it might be 20 hours a week or less. A lot of our clients only use 5 hours a week. It just depends on the situation and what their needs are. And so when we get into Interim, that's usually when somebody walks out the door, and we walk in, and that might be 20 hours a week or more, but it's a much shorter duration. What we're doing, it's a major difference in that we're setting the stage for the next person to come in.
So you're doing a stopgap position to make sure that the responsibilities are covered, and then setting things up to be able to hire the person who's going to come in and be full time again.
Right. And so the goal is different, but it might be the same CFO. It's just the goal is very different, and the amount of time is really focused on the 3 to 6 month period when they're searching for a CFO, and it really gives the clients a boost in that when they're going out trying to hire a superstar. Superstars don't like to walk into dumpster fires, and so sometimes things can get hairy. When somebody leaves, there's a lot of things that are left undone, and sometimes a mess. And we can clean that up and have it ready for them and hand it over. And not only that, train them up to get up to speed very fast. And so the value proposition is really, we bring that top flight talent to the lower middle market, but we're very versatile in what we do. And so when we're talking about, the 10 to 50 million range is a lot of what we see. We see a lot of that where, the owner and the CEO has outgrown their team, where they've had a team for maybe 5, 10, 15 years or more. And it's that person that's in charge is the person that knows it the best. And so as they've grown and up and to the right, it's really important for that owner and CEO that may not have ever had a CFO to understand what a CFO brings to the table, because it can create a lot of friction and cause problems later when they're looking at that person and saying, hey, you're the finance and accounting guy. Why can't you do this M&A, due diligence? Why can't you, restructure my bank loans? Why can't you, work through these contracts or do board reports or merger integration things that, more are outside of the box type thinking that a CFO would bring to the table. And the person that's sitting in that chair is very much in the box and focused on the day-to-day journal entries and controlling the business and closing the books. And it's a very different personality. It's a very different skill set, and it's certainly a different mindset. So
Okay. And so we're going to have a big discussion here today about regrets in M&A deals. And you recently published a blog post that we're going to refer to a few times. I put the link to the URL in the show notes. But in our pre-call, we talked a little bit about how, since you're based in Houston, you actually have quite a bit of exposure to the oil and gas industry, and it kind of led us down sort of a rabbit hole conversation about cyclical industries. And since I've got you on the line here, I wanted to actually ask some questions about that before we get into the main topic, because it's interesting, and I don't think I've spoken with anyone about it before. But there are generally a couple of businesses that are well known for having a certain cyclicality to them. Can you take us a little bit into that rabbit hole that you and I were in? Like, how should people be thinking about cyclical industries? Because, these things rise and fall, and it can really create a challenge if somebody's thinking about doing a deal, whether to buy or sell a business in that kind of environment, because they kind of need to look at where they are in that cycle.
yeah, well, oil and gas services and oil and gas in general follows a different pattern than a lot of the other industries. In general, you'll see that the rise and fall of different industries, it follows about a 7-year pattern. Some of them follow the economy almost to a T, and some of them are counter-cyclical, and some of them march to their own drummer. Oil and gas, on the other hand, typically runs in a 5-year pattern. And I don't know if it's presidential cycles or whatnot, but the one thing is clear that when you're up, and when you're down, you're down. And it's the oil and gas, as far as having that in your background and being a really good turnaround CFO, they go hand in hand, because you learn very fast how to pivot on a dime and manage cash flow quickly. If you don't, you're going to be out of business. And so it's really it's really critical to know your cycles within your business. So if the big lesson learned is, when you're thinking about going to exit your business, You need to start looking at the cycles and when it's up and when it's down and when valuations are up across the board. Sometimes they peak out sooner. Consumer packaged goods is going to be one that is going to follow very different than oil and gas. And so,
because it's not just that the earnings change as businesses go up and down through this boom and bust cycle, but when you're down, people lose confidence. The multiples can become compressed. You can get a lower multiple of cash flow at a
right,
time when cash flow is low. And then when things are riding up, people get excited and the multiples can actually expand at a time when earnings are expanding. So you get this bigger high. With oil and gas, is it something as simple as when the price of oil is high, people make the CapEx investments to increase production, and then by the time that production comes on board, you've got more oil now, supply and demand makes the price go down? Could it be as simple as that cycle of investment and supply growing and falling, et cetera?
well, oil and gas, so it can. There's several factors that maybe make it more complicated than most. Most of it is a simple business model, but especially on the oil and gas services side, which we see a lot more of VCFO than we do the oil and gas production.
Mhm.
But uh, the you're right. When the oil and gas markets are up, people are a lot more willing. Like when the price of oil is high, they're a lot more willing to invest in capacity. And sometimes they don't know exactly what capacity is going online at any given time. So, given that the market's up, everybody's dumping money into capacity and production capacity goes way up. And let's say the price of oil moves like it did maybe in 2015, 14, 15 era, when it went from 120 to 45. All of a sudden the price goes down and you got all this excess capacity on there. And so what it does is it takes a while, and that makes this down cycle longer, is when the excess capacity is online, they have thresholds about what it takes to get the oil out of the ground. And there's always a price floor where it becomes very unprofitable to even run your wells. And
Mm.
so then, whether that's $45 or if it's 65, um, there's always that threshold. And so you have to work through that excess capacity. And what they do is they start capping wells and they start, you know, ceasing production because it's more expensive to pull it out than it is to sell it. So that's what, once they start doing that, then they start back on the upcycle again. And so,
Is there something someone can do to make sure that they don't buy at the top of the cycle? Is it simply a matter of being aware of the cycles and trying to have that discipline not to get carried away with the exuberance and excitement that is probably building in those upswings?
well, there's a lot of psychological things you can do. I mean, for example, like they always seem to get caught off guard. And when the money's flowing, it's flowing, and you don't necessarily, you get whipsawed by maybe geopolitical events. It just takes one missile in the Middle East to change the price of oil.
Yeah.
And so you can get whipsawed at any time. But usually when you see, and I read this a long time ago in a book called Frenzy, and I don't even think it's in publication anymore, but it's basically the psychology of when you have a bubble and when you start having people, uh, and this happened in the dot-com era too, when you start having people announce that the old valuation metrics and the old way of just doing business no longer matter. So, for example,
This
like,
time it's different.
yeah, it's always different. And so when you know that,
Yeah.
when you see that and you hear that, it's a pretty good time to start pulling back and you start, or, exiting. Because you never know whenever, it's like a merry-go-round at that point. You never know whenever the fundamentals are going to snap back into place. And for example, when I remember in, the 2000 era, right around when the dot-com bubble was going on, and they were like, let's value this with clicks and eyeballs, no longer cash flow, but same thing with
Yeah.
oil and gas. Let's start looking at other metrics. When they start trying, and what they're doing is they're using other metrics to justify the valuation.
Right.
That's when you're at the peak. And
Have
so,
you ever been working on an M&A deal when you've hit that shift point? Do you have any stories you can tell about being at that moment, whether from the buyer or seller side?
Yeah. Well,
Obviously confidentially, like, don't.
no, this one is I was working. We didn't really dive into my background, but I worked for a German investment bank, and this has happened several times. I'm almost always on a deal that when the tide shifts, it shifts. But this is an example of being the overconfidence bias that I'm talking about in my blog. So I was working on a mortgage-backed security fund for the German investment bank. We were originating and buying mortgages for basically gringos in Mexico. And so it crossed three borders. The equity was coming from Germany. The debt was coming from the U.S. We were getting it rated by Fitch with A-rated paper. Well, A-rated paper, but it was downgraded a little bit because the assets were in Mexico. And so it was basically Americans and Canadians buying second homes in Mexico. Yeah. And so I remember following that market and watching the home builders, really run up, and the mortgage-backed securities really run up, and they were using justifications. They were doing the exact same thing of using different justifications to value mortgage portfolios because the old metrics no longer mattered. I ignored that, and so did everybody else. They were also using it how they valued real estate. And they were all screaming, it's going to go up and to the right forever. It's like, and when you hear those terms, it's time to pay attention. And I remember following the subprime market and the way that, everything, that was basically the pin that was pulled on the grenade is like a subprime, and it blew up and nobody could value them. And it was going to the floor, and it's kind of like, we're so thankful that we did such a good job at underwriting, these mortgage-backed securities, and how tightly buttoned up our underwriting process was, and in the origination process, and kind of like, those knuckleheads, they're all pushing that paper that was like absolutely worthless. They couldn't value it. Good thing that we're in this market and not that one. 3, 4, 6 months later, anything with the name mortgage was
it didn't matter.
Dead on arrival.
Yeah.
So it became a triage after that. Whatever was outstanding, we had to cap it and close it out as quickly as possible. It was a quick lesson learned on being like that overconfidence bias. That was certainly there, and I've done it myself, and that's why I warn against it now. There's other ones that, confirmation bias, that things that I talk about in that blog that are really important to not be going to look for facts to justify your case. And so it's really, I warn about it because I've done it. And the whole thing about, the blog that you were talking about, the whole reason it came about was I was getting interviewed for a magazine article. And they were saying, well, tell us about your deal experience. And I was like, well, I've had a lot of deals that on the both sides of the buy side and the sell side that have gone through, and a lot more that haven't. It's like, sometimes the best deal is no deal. And they're like, what? You'd think I guess today's a bad day to say this, but hair lip the Pope, but is the expression. But the reaction that I got, and I was like, well, let me dig into this and explain it a little bit better. And I don't think, the more that I dug into it, I realized most people don't talk about, there are good times to walk away. There are things that you need to do to guard yourself about having a bad deal, because the worst thing you can do is push through a bad deal and then regret it later.
Yeah. Well, we've got people that have tuned in here from all over. We've got Kevin, who's joining us from Lakeland, Florida. We've got Victor, who's over in the UK. Compass has joined us, says, good morning, everyone here. Victor has a question before we move on to the regrets article that you had written. He wants to know, how much of a challenge is it for a fractional CFO to maintain focus on numerous companies? So that's a great one. I mean, obviously, you'd have a person who's working part-time on any one company. He's got several clients.
Right.
Tell us a little bit about the sort of focus issue, I guess, that a part-time CFO would have to tackle.
Yeah, well, personally, like like you almost have to have a little bit of ADD. And like we hire fractional CFOs based on their personality. And any CFO, they're not going to have 20 different clients. They might have 3 to 5. And
Okay.
so 3 to 5 is a manageable number, but you get above 5, and then you're going to have a distraction problem. And so really, in that 3 to 5, one may be hopping 1 week, and the next week it's dead. And then so you can actually ramp up and ramp down. One of the worst things you can do is have a CFO that spends an hour a week. And like, so this is why whenever I talked about below the 10 million mark, where they have just a really limited budget, and it's like, oh, we only need 1 hour a week. It takes a little bit of time to get yourself back into that place, and spending 1 hour a week or 1 hour a month is not productive. And that's exactly the reason I think that he's asking that question is you don't want to be so distracted that you can't add value.
All right.
So
That makes sense to me.
yeah, and the same goes for the controllers and the HR people. We have 20 some odd CFOs on staff, and then controllers, maybe 20 more. And then we have several HR people, and they're all handling a load of 5 clients or less.
Okay. Yeah. Thank you very much. That I think that's great, because I can just imagine, with my own work, when I'm, going to look back into a client file,
Mhm.
it always begins with just reviewing the stuff and getting yourself back up to speed with what you were the thought track you had the last time you were looking at the numbers and information, and
Right.
sort of rebuilding, to use the example of AI, it's almost like you have to rebuild the frontmost, most accessible memory of what you were looking at before, just so that you can get back to the same point of thought, and then grow and develop your ideas beyond that.
Yeah, and the other thing is the personality angle of it, whether it's a controller that's more of we use the PI index, and we actually try to match our personalities of our CFOs up with the CEOs. And so typically we're looking at personalities that on the controller side, operate in the box and like the box. And then on the CFO side, operate outside the box and have more of a leadership role. And so there's another dynamic to it just than having a CFO that has multiple clients. And the other thing is, there's a difference between VCFO and, let's say, single shingle type activity, where you have somebody out there that might have several different clients, but it's only one person. Really, what you're trying to get at is having the personality stacked, but also the skill sets and also the rates. So if a fractional CFO comes into your company and it's a single shingle person, and they're running the journal entries, they're closing out your books, and they're doing all the high level thought. Number one, they're operating in the box and out of the box. Number two, they are you're paying the same rate regardless. And so we try to stack it to where we have overlap and control, like where somebody reviews the other person's work, because when you start staring at numbers long enough, especially in spreadsheets or any other system, errors can be made. And so we try to make it to where we have oversight at each step of the way.
Okay. Let's talk about the blog post. It was called "When No Deal is a Good Deal," and you talked a little bit already about what inspired you to write it. In that blog post, you mentioned emotional and cultural factors as major contributors to post-deal disappointment. Can you unpack that statement a little bit? Like, what amongst these emotional and cultural things are often overlooked during due diligence or the seller's preparation to exit?
So you've got several. I mean, I guess you're talking about the little grid that I had in the blog post. So there's 2 angles to look at it, and sometimes it actually end up both ways. You've got seller's remorse and buyer's regret. And on the seller side, there are things that, I mean, obviously, like if you sell your company and they take it, from a $20 million company to $100 million company, within a year or two, you've left something on the table. And the moment you realize that, there's going to be a little bit of you might get your earnout, you might get your full earnout, but there's also a little bit of a remorse there going on about, could I have taken it and done something more with it? The other thing is and this happens a lot, where, especially on the strategic side, when the buyer, through the negotiation process, this may be the first time that this seller has ever sold anything. And it's a very steep curve in learning about what to do and what not to do. The buyer, especially on the strategic side, will come in and say, oh, nothing's going to change. And it won't be shortly after the ink dries before you realize everything's about to change. So as much as there's the promises are there, I would take them with a grain of salt. And I'm sorry.
So I was just going to say, what are some of the most surprising regrets you've heard sellers vocalize?
Well, the seller vocalizing what the buyer had promised them.
Well, just surprising statements that you've heard post deal that you really didn't expect to hear. Because I've heard of deals before that were about to fall apart until the buyer offered the seller, for example, to keep his office or something like that. So the guy could come in and feel like he was still part of the team, even though he had sold the business. I've heard a lot of stories over the years of sort of just things that sound kind of odd from the point of view of deal making, but when you start to understand how attached and integrated some of these people are in their businesses that they built up over the years, you realize, oh, that kind of makes sense. Like the person has some a problem separating their identity out of this in some cases.
Yeah, that's probably the number one issue, when they've built their life and they've built this company up, and so the culture obviously it gets changed. The buyer is always going to trump the buyer culture is always going to trump the seller's culture, and it may happen immediately if it's a stark contrast. If it's a very stark contrast, it'll end up with a kind of a political infighting type thing, or resistance to change. And so when these sellers do actually sign, there's one thing that they probably haven't thought of. They've been thinking about the exit and how much money that's going to bring them, but money doesn't always bring happiness. And they hadn't thought through the motivations behind what they truly loved about their business, and then how people saw them before and after. They're going to see people come out of the woodwork, and that they view them as Mr. Moneybags now, or the center of power is no longer with them, or they're being told what to do, and they're not used to being told what to do, and they're being put on KPIs and metrics. And typically when an M&A transaction goes through, the first year at least is a lot of turmoil. There's a lot of change, and how they navigate that change, it really depends on their mindset and their outlook. And if they're shocked to find out that they're no longer the boss person, and everybody's gravitating towards the other person, and that was part of their motivating factor, and what motivated them to get out of bed, or how they dealt with clients, how clients viewed them, and how they fit into the puzzle. It's a shock, and it can be, and you combine that with the chaos of the first year, and you're trying to hit your earnout, and chaos basically spells it basically disrupts the focus of the entire team.
Mm. Now you're mentioning things like earnouts and stuff. So you're talking about scenarios where the seller has to hang on for a certain period of time to help achieve certain goals within these businesses that have been sold.
Yeah, I'd say, these buyers, they're not buying so this is part of the build-up process, and the goal of the seller is to, over a period of time, almost work themselves out of a job, because the buyers are not buying that person. They're not buying the owner. They want that owner there to make sure that the transition is complete and it goes well. but the problem is that it's not always thought through very well, especially from the seller of thinking through what motivated them, why they're there, what they're there to do, and once they've gotten through that transaction, it's almost like a relief. But that's where the real work starts, is trying to integrate those companies. And I'd say 90% of the time, on the lower middle market, the buyer is wanting the seller to stay at least for a short time, and there's almost always
Sure.
an earnout attached to it. So
Yeah. Just to your point about, how the seller sees themselves, I was having a conversation with someone just the other day, and they were reflecting upon how as they were approaching the sale and getting ready for a sale, they began to reflect on things, and they began to realize just how much being a business owner, just holding that title, was a very important thing status-wise for themselves. And it kinda led into this audiobook I was listening to, a couple weeks ago, where they were talking about the difference between earned and bought status symbols.
mhm.
And, b people who have the story of, starting or buying a very small business and growing it over the course of a career. I mean, this is an earned status qualifier that is really rare, across the broadness of all people, right? And, I can totally see how someone might start to hesitate, realizing, "Hey, I'm no longer gonna have that, tag associated with me," or what have you. For some people, it could be a real hit to, visions, or the way they evaluate their self-worth, or certainly for things like ego.
Oh yeah, all of the above. I mean, it's certainly, uh, especially when you've had your team start shifting away from, from you as being the go-to person as far as the power center and keeps the company together, and to the
Mm,
buyer, and that's a real eye opener, and it's really, human nature, but it's not well thought through until you actually experience it, and then that actually leads into a little bit of overconfidence bias, and some of the biases that I'm talking about in that blog.
and that was exactly the next question I had on my list here, is just, you talk about cognitive biases, and you listed overconfidence, anchoring, sunk cost fallacy. You wanna talk a little bit about those and some of the ones that you see crop up often, and how it affects these deals?
Yeah, so a great lead in for that is that, I mean, I've already talked about two of them, but the sunk cost fallacy is when you're trudging along, and sometimes these deals take anywhere from 9 to 9 months to complete due diligence and complete all the negotiation and finalization of docs, and sometimes longer. I mean, and sometimes they can drag on for much longer. Um, the sunk cost fallacy is basically looking at, oh man, I've already got all this time in it. I don't want to restart with another buyer. Let's just get this over with. I've got this time invested, this money invested. I've got several $100,000 of legal fees and advisor fees, and let's keep riding this horse. And
Yeah.
like, it just keeps piling up as far as, and it never gets better if you think of it that way. But if you think of it in terms of opportunity costs, or how much have I been distracted on this deal, uh, that may or may not work, and it seems to be every time you turn around, it's a if it, and I can promise you, if it's a grind through the transaction, it's going to be a grind after the transaction. Like that's a really good indicator. But that sunk cost fallacy can keep you on the hook way too long, where you should have called the ball much earlier in the game.
Yeah. Dustin, someone just hit the like button, the thumbs up button, and we've got like 70 people live here. So
Yeah.
please, guys, if you're enjoying the program, hit the thumbs up. It's the easiest thing that you can do to help demonstrate to the algorithm that the content on this channel is good, and it'll the guests feel so much more appreciated when they get those likes, don't you, Dustin?
Oh yeah. I can't see it right now, but I'm certain that yeah.
Uh, what 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 do you think are some of the signs that appear, that tell you that a deal is being driven by ego or emotion more than actual strategic logic?
Well, one of the ego and emotion, you can find it really shows itself in the amount of control and the amount of inability to think through problems. It's either my way or the highway type issues, and it goes on both sides. The adage of the golden rule of he who has all the gold makes all the rules. And so you'll have the buyer come in, and they're and I've seen this happen, and
Me
uh,
too.
they come in, and part of the reason why they're even buying your company is that they think they can run it better than you, and that shows up. And so when you're negotiating, and it's been your baby, and they're like, before the transaction is over with, they're gonna call your baby ugly. There's going to be something that they find in due diligence, and they're kind of like, ooh, what about this? It's like, this is going to cost a lot to fix, or this is a huge risk that we didn't know about. And so they start retrading the deal. And like every time you retrade a deal, you should only, like, 1, 2, 3 times. But if you're like once a month retrading a deal on on a transaction, which retrading I mean by they're coming back and asking for a discount on this or that, or they're stalling, they're kind of waiting you out, things of that nature. Those are the red flags of when to really think about walking away. But then I mentioned that when they call your baby ugly, you got to guard yourself. And this is the reason why it's really good to have transaction people, with veteran transaction people around you, because they need to help you talk you off the ledge. And because it's going to make you mad. Like, when they call your baby ugly, you may know about it, and hopefully you do when you go in, all the warts on the baby. But if you, like, the pride and ego gets into play, and you have somebody that may be having that going on the buyer side, and they detect it on your side, well, they'll use it against you. Like, they'll work you to the point where you've made a huge mistake because of your pride and ego.
Well, and I think too that it can be very easy to believe that if you found a buyer who is willing to make an offer and willing to invest in the due diligence and to get themselves sort of knee deep in the expense and work of moving towards that closing, that there then must be other people who are obviously ready to do it as well, and it may or may not be the case. Um, I I've found that often with sellers where they'll kind of get the syndrome where they believe that because some people have shown up and shown some interest in their business, and some of them have made an offer and they've been able to make an initial deal with one of the buying parties, that they kind of have this golden goose that everybody wants,
Mm-hmm.
and it can really make you feel like you're in control of the process. But what many of them don't appreciate is just how often deals can fall apart in due diligence. And then if the deal falls apart one time, that's going to make all the other buyers potentially a little more skeptical and aware that, hey, something went wrong for the first buyer, or that, why are we getting a second chance at this? And it, sellers can undermine their own opportunity of success with other buyers by cutting these processes short.
Absolutely. The the Well, number one, when you sign that term sheet and you start that due diligence process, it is much better to cut it and run as at first at the first sight of it, but of the problems that you might be experiencing. Uh, Not always, but you need those advisors around you to help you determine when that break point needs to be. Uh, but also, you want an NDA attached to it, so that whoever is courting you at the time is not at liberty to go and speak about whatever they found or whatever they did and how it fell apart. But a lot of times, as long as you have a good transaction team around you, uh, when you go through that process, you need to have criteria of, hey, here's my walk away point. This is what I'd walk away on. And you could be able to explain it to the next person that you're talking to. The last thing you want to do is, I'd have to, like, dig into it, but the term that I think that you're referring to is the Cinderella syndrome. and you're
Sure.
thinking that you only have one prince, and that prince has your glass slipper with your name on it. There's a lot of them out there, and that's the critical part of having a bidding process. And I know that you create a bidding process with your clients. Investment bankers do the same thing. It's really important to understand that the single buyer, especially going into term sheets and transactions, can be a dangerous trap. And
Well, so you, I mean, you are dealing a lot with lower mid-market and mid-market businesses. Most of my clients are Main Street and lower mid-market. And so there are some little bit of differences that happen between those two different sizes of businesses. And so we're talking about experienced advisors in the space that you're in. Who do you think are sort of the essential team members for buyers and sellers to make sure they have really good experienced people? What are the labels or the titles of these people that they've got to have right on their team?
yeah, and the timing is important too. They're all important, but the timing of them is very important. Obviously, one of the reasons I'm here is, if you don't have a CFO and one that has transaction experience, it's critical. You've got to start 3 years to 5 years out, focusing on up into the right numbers, getting your KPIs and your metrics going, making sure all your process and procedures. Because remember, when I mentioned buyers, they're not buying the owner, they're buying the business, and all of that entails process and procedures and the engine that they're building, not the owner that's driving it. So first and foremost, I would say that obviously attorneys, transaction attorneys specifically, that have a lot of deal experience, and along the same theme with this blog, that it's okay to have lost a deal. It's actually a good thing. You want some people that have had their teeth kicked in and lost deals because either, like what I mentioned on the overconfidence that I had whenever we were doing mortgage-backed securities in 2008. So the other thing is to make sure that whatever avenue that you're taking as far as your exit, you might have an exit planner involved, and they're looking more holistically at your personal assets and what you're going to do. That needs to start 3 to 5 years out, and that'll lead into tax questions. But also, you need to start 3 to 5 years out talking with the different avenues to a liquid market. And what I mean by that is, for example, your service that you have, or investment bankers, brokers, broker dealers. Start assembling a team that's going to help you get to the other side. That when your expertise is, as far as owner goes, is focused on, selling your product and building your business, theirs is helping you sell your business. And they've been there, done that many times over.
Mm.
So
Yeah, it's about preparation, really. And the the sort of the worst outcome scenarios that I see all the time are the people who just delay. They just work with their exit plan is live forever. And so, but then one day something happens and they realize, geez, I need to sell. And then all of a sudden it's a scramble to do a deal. And all of the prep work that you're talking about just hasn't been done.
yeah,
And then they end up having to mitigate through maybe concessions to the price they might get, or they have to do maybe looser deal terms than they would like because of things that haven't been set up properly, et cetera.
yeah. So I'll draw on a little bit of experience here, but it's easy to kick the can down the road. And then all of a sudden, one day you get a call from a prospective buyer. And this is the worst thing you can do, is just, number one, put all of this off. And then number two, have a prospective buyer and run with that without going to trying to get a sell process going where you have multiple bidders. Because multiple bidders, that'll play into the pride issue of somebody else is going to get my deal type thing. So they'll push the values higher. So whatever transaction cost you might incur from selling the business, it far outweighs it, on value that you might get out of your business. But I've been in that situation where I'm sitting across the table with the owner, and a strategic buyer shows up, and it's a very viable one, and pride issues to the max especially from the buyer side, uh, and it was a pretty hairy negotiation, and I'm sitting across the table and I'm saying, look, we haven't completed the process. You're 1 year into your turnaround, and let's pull the plug on this. He's like, no, I'm tired. I'm ready to go. And I'm like, all right, well, that's a choice. You can make that choice. But the problem is that if you don't complete the process, so like 3 to 5 years advanced planning, you're going to have that. It's like you could have the choice. The answer might be, no, I'm tired. No, I'm sick. No, I've got cancer and I've got to sell. And the buyers know it. If you only have one person at the table that's bidding on your business and you have to sell, the valuation ding is going to be substantial.
Yeah, it costs.
Yeah.
That's just it just costs. Yeah. We have some questions from people here. You want to take a look at some of these questions?
Sure.
We have a question here from Compass. Says, what's a creative deal structure that you've seen work really well?
Well, this is a broad answer to the term. Is when you come to the negotiating table, it's always best to come in with an open mind. Mm-hmm. There are 20 ways or 100 ways to skin a cat. I mean, it can be where you can focus on in the typical one I always see that starts out, especially on an unprepared seller. He's thinking he's going to get, sell his company and get capital gains, and it's going to be a stock deal. And then even at the very first contact, they say it's a stock deal, and then they switch it at the end, where it's part of the negotiation, because they're always wanting to redepreciate your assets. But that always ends up sending a ordinary gain through instead of a capital gain. And so being creative about how you structure your deal, and you're like looking at it from a perspective of what is the ultimate cash flow of what I'm going to receive in return for what I'm giving up, is the mindset you need to have. And it doesn't always have to be a cash flow. It might be things that you might be receiving that you didn't have before, that are critical to getting a deal done. Like you mentioned that something as simple as a corner office, that if that has value to you, have at it, but the more creative structures, it really gets into the tax planning side of things, where you can have multi-tiered partnerships and things of that nature, where you hit certain thresholds and you get certain cash payouts. But the critical thing is to never get locked into position until you're ready to close. I mean, you've got to be on your feet and think through what the other side is wanting and what you're needing.
Because there are actually always three people at the table getting something out of every deal. There's the buyer that gets the business, there's the seller that gets proceeds, and then there's the government that gets taxes in one way or another, either at the table or in the form of tax payments paid by the new operator or whatever. Mm-hmm. And so I find a lot of the times the buyer and seller often forget that they can work together to try to make the third party get less and hopefully share some better proceeds between them. But almost always, to your point, this requires advanced planning and the input of people who understand what they're doing to sometimes change where assets reside, what entity they're in, how you're set up, all kinds of stuff.
Yeah, absolutely. The tax planning needs to happen 3 to 5 years out. And there are things that you're going to be looking for, like especially on this is beyond probably the scope of our discussion, but Section 1250 under the tax code, that's more has to do with small business stock, but getting yourself positioned for it If you're an S corp, really think through what that means for you to exit. If you have real estate in your deal, really think through whether that should be in your deal or it should be outside.
Yeah.
There's a lot of things to consider. The key is getting started 3 to 5 years out, and then being ready for whatever they throw at you whenever you're at the finish line.
The mech engineers got a question here about over enthusiastic buyers. He says, what happens to these types of buyers? Do they usually go bankrupt, or do they have to sell part of the company at a discount? Like what happens when people get overexcited and end up overpaying for a business, in your
Well,
experience?
so this actually is addressed in the blog. When you have an over enthusiastic buyer, there are some, the knights in shining armor, that are going to come in, the Googles of the world, and they're going to way overpay for your business, crowd everybody out, because that's something that they think they need. But an over enthusiastic buyer is going to be in that category, the white knight, which they're very rare, like very, very rare on the lower middle market. But the thing that I would really be concerned about as an over enthusiastic buyer is sooner or later, this is 6 to 9 month process, and somebody's going to wise up to, they've way overestimated the cash flows of what they could get off your business. If they don't, great, but it might speak to some deal inexperience. And that's one of the worst things you can have, is somebody that's never bought a business before comes in and wants to buy yours. And you've never sold a business before, and they've never bought a business before. That is a recipe for a circus. I mean, like bring out the clowns. It's that always ends up with a retraded deal at the very end. And so it's always best to kind of temper your enthusiasm and wait and see. But there's things you can do to guard against that, which is upward due diligence, and start checking into what their deal history is and how they've resulted in the past. And if they've never had a deal and you've never had a deal, I would be extremely cautious.
See, this kind of stuff it really messes up the Main Street market, because what happens is on Main Street is that you can get that inexperienced buyer, and let's say they're buying a business for under $1 million, and they've just sold their house that they've owned for the last 30 years in California, and they literally have this money in the bank. And so that buyer could go and well overpay for a business and never have that moment where somebody shows them that they're doing something dumb and they overpay for the business. And what that does then is it taints the expectations of other people in the marketplace, because now sellers at the golf course hear the story about the guy who sold the business for well over what it's worth. And then they think that they can get that too. And the reality is it's kind of a dice roll, because sometimes they can meet that uninformed buyer, let's say, who just happens to have money. But more often than not is what you're describing happens, where they'll put the business up for sale at a crazy asking price. They'll meet an equally inexperienced buyer, maybe who doesn't have the money. They didn't just sell the house in California. And then the two of them will, negotiate, get an LOI, start due diligence, and then some banker will show the buyer that they can't afford it. And then the deal will fall apart after they both wasted 6 months of time, right? This is, I see this continuously in the Main Street space. And you're right, it's people that don't have experience, but the fact that they sometimes happen is what really skews things, because the sellers believe that there's a precedent, or they believe that there's evidence out there showing them that if they just hold out, maybe cross their fingers enough, that that they'll luck out and have this happen to them too.
Yeah, and that gets into some of the biases that I was talking about, and actually gets into the buyer side of overestimation, but the biases of basically the confirmation bias and the overconfidence bias. But I've actually been in that situation where, as CFO of a company that the owner wanted to sell, and I was there to help with the turnaround, and somebody down the street in the exact same SIC code business got $100 million from a private equity fund valuation 5 years before, and that's what he wanted, $100 million. At first, I was kind of like, well, let's dig into things, and at the time, it seemed kind of cheeky about, hey, that's a nice valuation, but let's dig into things. And I come back and it's like, well, we got 3 million in EBITDA, and this isn't and you're not only that, you're taking half of that and pocketing it, and 1.5 million goes back to the company. And so not only are you not reinvesting in your company, you've got 3 million EBITDA, and you want 100 million valuation. It's like, that's just not going to work. There's not a buyer out there in the universe that would accept that. And either you got to find a really dumb one, it's like, and so, and it wasn't in an industry that was high technology either. So, being really, not being like cognizant of what's going on and what's realistic can really hurt you. So, like, let's say that that seller allowed many tire kickers to come over and look at the company, and they all back away, and that's a pretty good indication you've mispriced your company. An asset is almost, there's a price for almost every asset you can sell it, but just being non-observant and almost stubborn about what the guy got 5 years before and in the different cycle of the industry is a huge fallacy. You can take and waste a lot of people's time, and that's actually what happened. And that business is still not sold. And so it really hurts to have over enthusiastic seller that has misguided valuation expectations and expectations of a transaction, and they've never sold anything. And then you could waste a lot of time if you have somebody that comes in really enthusiastic to that person because they want to make a deal work, but it just won't. The mechanics aren't there.
Dustin, this has been a great conversation. If people want to meet you or read more of your stuff online, what is the easiest place for them to find you?
So vcfo.com is the website. My email address is dwilliamson@vcfo.com. And, all of our contact information as far as which different markets, there's a managing director for each one. And, obviously this blog that you're linking to is to our website. So you can get in contact with us that way. And on LinkedIn, it's just Dustin Williamson. There's no numbers, anything. I guess that was the first one.
We will. We're gonna add the link to your LinkedIn profile in the show notes as well once we're done here today. But I want to thank you very much. Thanks for bringing your fan club. Look at this. Melissa says Dustin has such a great reputation in the Houston area. Incredible contributions and value add. So there you go.
Oh,
so we've got some of your fans are here in the audience,
especially from Melissa. Yeah, she's great. Yeah.
Awesome. Thank you so much. And thanks for everyone who tuned in live. Please don't forget, whether you're live or watching the recording, hit the like button, leave a comment for us to respond to. All of this stuff helps with the algorithm, helps grow the show, and helps to bring interesting information and conversations like the ones that we have to more people all over. And with that, I'll say thank you very much. And we'll see you next time.
Thank you for having me.
No problem. So, how can you learn more about buying, selling, financing, and managing small and medium-sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally, and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.